This is Colin Cattell with Palisade Radio. This week we are speaking with Adrian Day. Adrian is a native Englishman known as a proponent of global investing. As an investment writer, Adrian gained a large following for seeking out unusual investment opportunities around the world. Now Adrian manages the asset management firm which carries his own name, Adrian Day Asset Management, which he founded in 1991. Adrian, thanks for joining us.
Oh, well, thank you very much for having me.
Adrian, you're known as a gold bull to many. What do you think are the fundamentals that are in place which will move gold higher from today?
Yeah, I think a couple of things. First of all, the monetary situation remains very favorable for gold, I think. You know, one of the reasons that gold has fallen over the last couple of years, particularly in the last year, is concern about the end of QE by the Fed. And although, they have had this famous tapering, the reduction of the bond buying. I think investors have overreacted to any fears of any reality of tightening. You know, if you look around the world, Europe just cut interest rates to negative interest rates. Japan pledged to double its money supply within 18 months. Double its money supply within 18 months, I repeat, in case it didn't quite sink in. Britain continues to be extremely accommodative. I mean, if you look all around the world, all central banks basically, to some extent or another, are being very, very accommodative. And, you know, the point is that over the last 6 months, they've even become more accommodative in general. So the Fed's tapering needs to be put in context. Let's remember that the Fed increased bond buying every month by $85 billion, and now it is cutting that back. That doesn't change a very stimulative policy, and it doesn't change very low interest rates. In my view, any meaningful tightening in the United States is a long way in the distance.
And I've heard you speak about the historic price action of gold in relation to today's price moves. Can we draw some conclusions from the 1970 bull market's correction, which sent the metals down 45% in roughly 2 years, to today's correction where we've seen roughly 35% correction in the price of gold?
Well, that's right. Any long-term bull market, it's not unusual for a long-term bull market to have a meaningful correction at some point mid-cycle. That certainly happened in the 1970s. And let's not, well, you went around, I was. In 1974-75, there were so many people saying, well, you know, the bull market's over, $35 to $200, what more do you expect, kind of thing. And, gold's just a relic anyway, blah, blah, blah. It's over. And you had the same sort of conversation this time. So if you look at many markets, you can look at Japanese equities in the 90s, you can look at the NASDAQ at the end of the 1990s. The end of the 1990s, Japan at the end of the 1880s. It's not unusual to get a meaningful correction mid-cycle. So I would simply put gold's correction in that context. And if you think that it was, if you look back to the bull market that we've had since 2001, you know, we've had pullbacks of 23% and 25%. So, you know, putting that in context, it's not so unusual. What was different, if you like, what was unusual about the pullback is that it lasted so long. It was the first long pullback in this bull market. Now, one other thing, if I may, putting things in a historic context, if you look at gold over 300 years, gold cycles, commodity cycles, first of all, tend to be long. Commodity cycles tend to be much, much longer for many, many reasons. I mean, we don't have time to get into economic theory, but for many sound reasons relating to the structure of production, commodity cycles tend to be much longer than a regular economic cycle or any other kind of cycle. Gold cycles tend to last, if you look back over the last, 300 years, they've lasted 35 years, 39 years, 39 years, 17 years. They've lasted a long time. And it's ironic that the bull market everybody remembers in the 70s was actually the shortest bull market on record. So if you look at this bull market starting in 2001, even if you look at some of the shortest bull markets we have, 17, 19 years, we're still only halfway through, a little over halfway through that bull market. Why would we think that this bull market, which was provoked by the development of China, which represents 25% of the world's population, or nearly 25% of the world's population, and has developed dramatically, at the same time as central banks are acting like drunken sailors on a Saturday night, why would we imagine that this bull market will be the shortest or one of the shortest on record? Doesn't make sense. So I think there's a lot further to go.
With many of the mining stocks beaten down up to 80 and 90%, I understand you're a buyer of the mining equities. What metrics are you looking for to identify the biggest winners as the bull market resumes?
Good point. Let me try to be brief on this. I'll try to divide the gold mining stocks into various categories. First, you have the big mining companies, Barrick, Newmont, Goldcorp, and so on. By and large, as a group, this is a tough business, an extremely tough business, and as a group, these companies have been pretty badly managed. And, as an example, they have tended, you look at all the acquisitions that took place in 2011 at the top, and compare it with the acquisitions that took place last year at the bottom, and you see what I mean. They always act. They always buy when they shouldn't be buying, and don't buy when they should be buying. Bad group. Now there are some exceptions. I mean, I would put a company like Goldcorp, for example, with great management, great balance sheet, a spread of properties in politically safe jurisdictions. I will put that as a sort of, buy, and I won't say hold, but a good long-term buy. Now, there are also large companies that are royalty companies that don't actually do any mining, but buy royalties or acquire royalties on other people's mines. That's a much safer business because you're not responsible for anything that goes wrong. Now, if the mine never gets built, or if the mine is nationalized, or whatever happens, your revenue can go down, and your revenue can even go to zero, but you're never responsible for putting more money in, if that makes sense. And so the margins of these companies tend to be run with high margins, low costs, good balance sheets. So, a company like Franco-Nevada, for example, which is the largest gold royalty company in the world, $6 billion market cap. It's got $800 million in cash, no debt, spread of properties. It's got about 340 royalties, and only about 35 of those are actually producing right now. So it's got a very, very good pipeline of future growth opportunities, and that's a very low risk. It's a low-risk business in a very high-risk sector. I also like some of the juniors, but when you look at the juniors, that's an extremely risky business. It's a high-risk business, very speculative, because the odds of making discoveries are against you, and the shares, because of that, tend to be very, very volatile. You talked about some of the mining companies that are down 17-80%. If you look at some of the exploration companies, some of those are down 90%. So it's a way of losing a lot of money very quickly if you're inclined to. What we focus on, I'm not a geologist, so I don't try to pretend to be one by looking at properties. What I look at is the business model, the balance sheet, and the people. So if you have strong people with a good balance sheet and a good business plan, they are much more likely to succeed, in my view, than, let's say, bad people with a lousy balance sheet who happen to stumble across a great property. So we look at people and balance sheets before anything else.
And Adrian, before the call, you mentioned that almost all financial sectors around the world are overvalued. I want to get your perspective on the U.S. general equities market in particular. We recently spoke with Jordan Roy Byrne, editor of the Daily Gold, and he believes that a potential stock market correction could be a trigger to send the precious metals higher. Others fear that a correction in the market could cause a 2008-style crash for the mining equities. What's your take?
Yeah, that's an interesting question. I've done some work on that. If you look back at history, the stock market, well, you have three components, really. This broad stock market, you also have gold, and you also have the gold stocks. Now, gold stocks tend to be more correlated to the broad stock market than they are to gold, believe it or not. Now, if you have a strong bull market but a lousy gold price, well, then the gold stocks won't do well. But by and large, the gold stocks are more correlated with the stock market than they are with gold, particularly on a shorter-term basis. You know, sometimes gold goes down when the stock market, sometimes gold and gold stocks go down when the stock market goes down, sometimes they go up. And sometimes they go up, you know, in contradiction to the stock market. And it seems to me that the factors are really depend on whether the gold stocks do well when the stock market breaks is, first of all, the most important factor is whether gold and the gold stocks whether they participated in the prior boom, such as in 1986, 1987, when the gold stocks were among the leading stocks. So they fell, they crashed when the stock market crashed, or whether gold and gold stocks are in fact depressed. And if gold and gold stocks are depressed as they are today, they've had 2 years basically of declines, I think a stock market break downwards, I'm not looking for a crash, so I hate to use the word, but a significant correction in the stock market, I agree completely, could be the trigger for a rally in gold. Yeah.
Adrian, great insights. Thanks so much for coming on the show, and we hope to have you back again soon.
Well, I'd love to. Thank you very much for having me.